Hi, good morning everyone. Welcome to today's webinar. Today we will give a sectoral update on Singapore banking sector, as well as the initiation on Asian Paid Television Trust and the company results on China Aviation Oil, Keppel DC REIT, Logistics Trust, and Singapore Exchange Limited. Firstly, we will present our company results updates. Firstly is China Aviation Oil. So last week, CEO announced their first Q results. We maintain our buy call with unchanged target price of $2 with forecasted dividend per share of 5.4 SG cents, and its last close price was $1.65. Now let's take a look at the results, the financials. The first Q 2017, the revenue went up by 3 digits to $3.3 billion. This was due to the increase in total trading volume as well as the rebound in oil price. As you can see that the first Q total trading volume reached 7.3 million tons against last year's 4.9 million tons. The gross profit went up by 17.4% to 15.5 million. This was due to higher gains derived from trading and the optimization activities. The share profit from associates and joint ventures went up by 5.1% to around $15 million. Again, this was due to the higher profit contributions from Shanghai Pudong International Airport. As you can see here, Pudong contributed around 86% of the profit from associates. In first Q 17, its total share profit reached around 30 million, compared with first Q 16's $12.1 million US dollars. Here is the trading volume breakdown. As you can see here, the volume from middle distillates increased by around 30% year on year to 3.8 million tons, and the oil and the trading volume from other oil products increased substantially by 123% year on year. So moving forward, we think that this year the trading volume will still have positive growth. And the gross profit margin was around 0.47% against last it was the highest since 2011. So according to the management, CL will aim to improve its trading margin, which is the gross profit margin, this year because it will try to optimize its trading efficiencies. So we expect that the gross profit margin in the rest quarters of this year will improve gradually. And the profit from Shanghai Pudong International Airport actually grew up by only 7.1% year on year, which was the mild growth. And still we expect that the rest quarters of this year it will gradually improve because of the seasonality. The first Q contribution uh, from associates and joint ventures will be a little bit lower. And moving forward, we think that the opportunities and challenges coexist this year because as you can see that the geopolitical and economic uncertainties uh, will be a quite significant factor of the business of CAO. Because we think that the regional geopolitical uncertainties will have a negative impact on the civil aviation industries. And also the volatility of the oil price will actually impact on the improvement of the trading efficiencies. And as of first Q of this year, CEO hoarded more than 270 million US dollars on cash on hand. So we still positive that it will have the watchers to conduct more M&A activities moving forward.
Hello, good morning. This is Richard speaking. I'll now touch on Keppel DC REIT and Cash Logistics Trust. So for Keppel, we still maintain neutral with an unchanged target price of $1.15. Our forecasted DPU for FY 2017 is 6.61 cents. This is a implied forward yield of 5.4% based on the closing price last Friday, $1.23. So now let's take a look at the different lines from the results. Gross revenue, you can see that year on year increased by 30%. This was mainly due to acquisitions. So you recall that they did 3 acquisitions recently. One was a 90% interest in Keppel DC Singapore 3 from the sponsor, and the other 2 are in Europe, in Cardiff and Milan from third parties. The higher gross revenue also was contributed by appreciation of the Australian dollar versus the Singapore dollar, and all these improvements were offset by a client downsizing at Keppel DC Dublin 1. The occupancy at this data center now is about 56%, and also impacted by depreciation of the other currencies relative to Sing dollar. Net property income higher also by 36%. This was backed by 5.7% year-on-year lower property operating expenses. For distributable income, you can see it's a 48% higher year-on-year. Take note that for first quarter of this year, it includes one-off capital distribution of 1.7 million in relation to the acquisition of the data center in Singapore last year. The acquisition of the data center earlier this year. So you can see for DPU, this is 13% year on year. This is showing the combined effect of the preferential offering and the one-off capital distribution, which is equivalent to 0.15 cent. So if we adjust out that 0.15 cent distribution, you see that DPU grew 4.2% year on year. Now this first bullet point is something which is summarized from their recent annual report. So this is the independent market research. So outlook for new demand remains encouraging until 2021. That's where the forecasted date goes up to. So for highest growth regions, they are Singapore, Australia, and Malaysia, where the forecasted net new demand is growing from mid-teens to low 20% year on year. and lower growth is coming from Europe, which ranges from high single digit to high teens. So Singapore is the largest single country exposure for Keppel DC REIT. In the short term, there's going to be some extra supply, so there might be pressure on the utilization rate in 2017. But in the long term, the outlook for uh, new demand still remains positive. Now we go on to the portfolio. So in 2017, they actually had 4 major leases expiring, but they've already renewed one. So now there are 3 expiring, and they take up less than 10% of the total lease by NLA. The one that was renewed at a marginally higher rate, while the remaining 3 that come from overseas, they are still in negotiations. In terms of strategy for their gearing, it remains unchanged. Manager has always maintained that they have a target gearing of 30%. So they're keeping to that now, and the strategy is to use the balance sheet, acquire using debt, and then when it reaches about 40% or so, they will do equity fundraising to lower down the debt again. So as the AUM grows, the manager has also mentioned that they could consider relaxing the 30% target, as absolute headroom would actually be growing in tandem with the asset base. Now move on to Cash Logistics Trust. Revenue was marginally lower. This was due to the lower income from Schenker Mega Hub, where there's still the ongoing dispute with the tenant, and absence of Cash Changi District Centre 3, which was divested earlier this year. This was offset by some contribution from DSC Up and Spotlight Warehouse. Spotlight Warehouse contributed about 8 days of revenue for Q1. Net property income lower by almost 6% due to higher property-related expenses, and distributor income was down 11% year-on-year. Take note that the distributor income for first quarter 2017 and 2016 both have a one-off contribution. That's the capital distribution from the divestment of the Kim Heng warehouse. So for first quarter of this year, there's a one-off of 929,000, while for the first quarter of last year, there was a one-off of about 1.65 million. So if we, so this translates to one-off of 0.103 cent and 0.184 cent here. And if we exclude these one-off and only include the recurring operations, then DPU is down 8.5% to 1.697 cents. For the portfolio-wise, there's a manageable lease expiry profile for FY17, but FY18 could be a concern. So for FY17, there's about 4.7% of NLA expiring this year. None of it is a master lease. For next year, 2018, there's about 21% of NLA expiring, about 13 coming from the CWT Commodity Hub, which is a master lease. The manager is already actively engaging the underlying tenants for renewals, and then remaining about 8% comes from pockets of space within the rest of the portfolio. In relation to the impending takeover of CWT by HNA Holdings Group, at the moment it's still business as usual for Cash Logistics Trust, as nothing has changed. In the event that HNA does take over CWT, the first thing to look out for will be the ROFR, the right of first refusal policy. So if you go and check the IPO prospectus, the condition for CWT granting the ROFR to Cash is that in short, the manager still has to be ARA cash, and CWT must hold at least 15% of the manager. So that's the requirement for the ROFR from CWT to remain intact. The other thing is that if HNA does acquire CWT, it's possible that HNA also can inject their own properties into cash as well. However, this leads on to our last bullet point where we still think our view is unchanged that the high gearing is one of the key impediments to inorganic growth for cash right now. The aggregate leverage is 43.1%. Our estimated debt headroom is 49 million, and this is in comparison to the 1.24 billion portfolio for cash at the moment. So in order to do any meaningful inorganic growth through acquisitions, it's inevitable that cash would have to raise new equity through the markets, and that would result in further dilution of units. So to conclude, we have maintained our reduced rating on cash, a slightly higher target price of 75 cents compared to previous. Our forecasted DPU is 6.69 cents, and this is a 7.6% yield based on the last close price on Friday.
So, okay, morning. We are, this is the Singapore Exchange Limited results. Okay, so basically the results has been flat, right? The interesting thing is that the SDAVs maybe is up, right? But generally the volumes have kind of plateaued. So the results have been, the top line has been really flat, just up about 1% year on year. So the thing that drove it really lower was actually the derivatives. This is a problem. The volumes came down, but the average fee per contract increased to 1.2. So we are seeing this kind of pattern when volumes pick up, then the average fee per contract actually comes down. And the net result is that it doesn't seem to be able to punch above its weight and push the overall top line higher. So this is the kind of phenomenon that we are seeing recently over the past year. Right. So likewise, as we have previously always guided, or we will encourage our investors to look at the expense guidance, right? So there's no change to the full year operating expense guidance, which still maintains at the lower end of the range of 105 million to 115 million range. But because the second quarter and third quarter expenses have been has been lower than usual, owing to what the management has previously guided, that actually the technology expense in 2Q and 3Q is low. So into the fourth Q, if let's say they still maintain this guidance of 105 to 115, it means that most of the expenses will be actually brought forward, right, backloaded into the fourth quarter. And so fourth quarter, what we'll see is the apart from the usual seasonal seasonally higher expense, we'll actually be seeing more staff hires. We'll also be seeing the technology expenses spiking up again in 4Q. They will be moving to the cycle where the technology expenses will be picking up. and also higher processing and royalty fees associated with a slight increase in the derivatives volume. So given all these expenses that's coming up for Q, we are also not seeing any near-term catalyst to boost the top line positively to offset the higher costs. So all in all, we have downgraded the SGX to neutral, at least on the near term, because of this development. So now we have lowered our target price to $7.45 as previously $7.75. Okay, so now we'll move over to our main piece, which is basically the Singapore sector report and our initiation on Asian PTV. So we'll start off with the Singapore banking and finance sector report. So here we discuss how is the Singapore loans market shaping up, and we also include the details to a visit to Sing Investment and Finance to discuss the changes in the regulations announced by MAS on the 14th of February. So the key takeaway is that the finance companies will be unshackled to finance and service SMEs better. So we will also give you a slight breakdown on how the numbers might look like, which is it's just a background envelope calculation. And for the next 6 months, the lackluster business expectations may crimp the SME loans growth. We emphasize particularly in the next 6 months because in this aspect we take a shorter term view. It's different from our previous sector report on retail sentiment, which actually takes on a longer term view. Yes, we could be bottoming out and we can see the improvements, but at least from the business expectation side, the next 6 months it will still be a little bit weaker. And third part is the elevated leverage on households. Okay, and it could deter the lifting of the TDSR because recently investors have been very optimistic over the partial relaxation of the total debt servicing ratio, and they might expect more to be done. But in our report, we show that given the conditions that still persist in the household leverage, we think that the full relaxation of the TDSR would not occur anytime soon, unless we could see certain improvements in the improvements in the growth of the household income and the amount of leverage that is being used relative to the value of the property and also relative to the income by the households. And lastly, we also show the how the local banks have been boosting the household loans growth, right? And we also argue about why would they be doing that in 2017. So essentially what's happened in 2016, the Singapore housing loans growth for each of the bank have outpaced the system loans growth, right? So the system loans growth itself is 4%, but we estimate that OCBC Singapore housing loans grew at 10%, UOB grew at 8%, and DBS grew at 12%. So quite clearly they have grown in expense of the other competitors in this space. And we expect this trend to continue in 2017. Okay, so the first part, the regulatory changes to finance companies and for their ability to finance SMEs. So the key change here is the regulation to uncollateralized lending. Originally, the policy was the original policy limits the uncollateralized business loans to a single borrower to the limit of $5,000, right? And $5,000 itself to any SMEs is actually not significant and not meaningful in that sense for business expansion. So the management has also mentioned to us that owing to that sort of insignificance, they don't really have much business to begin with within this uncollateralized business loan space. So now the limit is now raised to 0.5% of the finance company's capital funds. And so based on our estimation, the share capital and equity reserve for SIF is 320 million, right, based on FY16. And that could imply that the SIF uncollateralized business loans exposure to a single borrower could go as high as 1.6 million. And that is a lot more meaningful. So on top of that, there's a limit to the aggregate uncollateralized business loans could be raised from 10% to 25% of its capital funds. And therefore, in total, SIF could have an entire exposure, aggregate exposure of raise the aggregate exposure from $32 million to $80 million within the uncollateralized business loan space. So second part is the changes to the current account and checking services capabilities. The finance companies have actually acquired liquidity by providing fixed deposit services. So that's really on the long-term side of the liquidity management. So now with current account and checking services, they can capture the short-term side of the funding. And the short-term side of funding would allow them to lower their cost of funds because the cost of funds for short-term is naturally lower. And this will be able to, these finance companies will be able to match their assets and to liabilities as they grow the loans, right? So this is a natural progress, and we believe that this would help them a lot in terms of scaling and also in terms of widening their net interest margins. So some of the back of envelope calculations for SIF. So if typically on the market, the average yield, the average net interest they will earn is about 3% on uncollateralized business. That is on existing market for the banks. So we use this figure of 3% per annum as a reference point. And if we assume that the uncollateralized business loan size could reach $60 million, that would actually yield about 1.8 million in net interest income. And that would size up to about 4.7% to SIF's full year 2016 net interest income plus hiring charges of 38.6 million. So that is quite significant just on the uncollateralized business space. Some knock-on benefits that will come from that would be a better working relationship with SMEs, and from there they will be able to extend collateralized business loans by way of the stronger relationship. So okay, marginally positive business expectations from January 2017 to June 2017 was only supported by the electronics sector. In this chart, we show that all the other 5 sectors, excluding the electronics, are actually trending on the low side, near to zero bound or negative. And here, the electronics sector is shown to have a very strong growth since the first quarter of 2016. But as you can see here, the performance is very volatile. In 2015, it is actually close to minus, it went up as low as minus 40. So given the high volatility in the performance of the electronics sector, it could swing the other side and bring the overall business expectations lower. The services sector expectations are also weak, trending on the negative range. This is both for the outlook and also the operating receipts forecast. So given the weak expectations, the Singapore Business Federation has also polled the SMEs on what they're going to do, right, given the weak expectations. So in this index, they actually show that the intention to expand, expectations to expand in the next 6 months is also trending weaker. And what this really means is that for the loans business is that SME desire to borrow for capital expenditure and also for working capital loans would definitely be on the weaker trend. And here this is for the capital investment expectations for the next 6 months. It's also weak. Okay, so now we move over to the Singapore housing loans from the perspective of whether or not the TDSR could be released. And I would like to also further mention that why the emphasis on TDSR, because we believe that the TDSR is one policy that could catalyze a stronger mortgage growth. If the TDSR policy is not in place, then of course it's a very big catalyst to the overall mortgage growth. But as long as the TDSR is in place, the mortgage growth would definitely be in check. So the monthly income for the household homeowners, we have taken out the monthly income for households in landed properties and for condominiums and apartments, because these are two areas where we look more closely at when it comes to the mortgage growth. So you can see here that the monthly income as of 2015-16, they are hitting at the zero growth rate. Then here we look at the growth rate of the private property mortgage year on year. As you can see, after the second quarter of 2013, where the TDSR policy was implemented, the growth rate has plummeted from a high of close to 12% down to now current levels of 4%. So if we look at, despite the TDSR being in place, the growth rate of mortgage is still at 4%, and 4% is higher than the growth rate of your household incomes of occupants in the landed properties and the condominiums. The second part about I would like to explain why we use this comparison is also because why we could use this comparison is because of the high ownership rate ownership of property here in Singapore. So the landed property is 90+%, while condominiums are 80%. So this is a good, owing to this high ownership, the comparison will be a good indication of the household health, or the way the amount of mortgage, right, that they are applying to own property. So here's a comparison between the mortgage and mortgage to income. So we can see that actually the private property mortgage to income is at an all-time high over a 16-year period. It has moved beyond one standard deviation, and it's still trending higher despite the TDSR being in place. And here's a comparison on the mortgage loan to value. It's also at a 16-year high, surpassing the level of the Great Financial Crisis in 2008. So given all these ratios, it doesn't paint a picture where the policy should be released, at least from the perspective of the policymakers. At least what we will try to look at is if the household incomes could rise faster than the mortgage growth rate of 4%, then I believe we will be able to see some possibility, a higher possibility of TDSR being released, and therefore a catalyst to grow the mortgage loans, and definitely will be beneficial for the banks under that scenario. Okay, so the next part will be the building and construction loans. We will expect the building and construction loans to rise close to 20% by end of 2017, in tandem with close to 20% growth in building and construction contracts awarded. The bulk of the building and construction contracts, right, is actually from the public sector, and we estimate about 50% of the 2017 tenders to be out by first quarter of by the first quarter of 2017, and they would be ready to commence by end of second quarter 2017. And that amount of contracts would worth about $16 billion. And with that amount of contracts, we could see the bulk of the public sector building and construction loans added in the second quarter of 2017. And so how does it affect the banks in a sense? So for the building and construction sector, we'll show that actually UOB is gaining a lot of momentum for in capturing the market share in the Singapore building and construction sector. For the housing loans part, all three banks are actually moving in tandem, right? But we were alluded to the fact that the housing loans still remains, at this moment in time, still remains a very high quality asset for the banks to acquire. And we argue here that actually they will be moving there more aggressively because they are faced with loans quality deterioration in other sectors such as the commodities and the oil and gas. And also, how are they actually beating the other competitors into gaining more market share? We also alluded it to the compliance to the net stable funding ratio, which is actually a Basel initiative. So the banks are required to maintain a stable funding portfolio profile in relation to the composition of the assets. So they may have to, if they have less available to them, the long-term funding side, they may have to reduce the mortgage business so as to better match the tenure of the assets versus the liability. And this could also lead to higher costs of funding for the foreign banks. And given that the Singapore banks are competing aggressively in home loan space, of course, how they will price the loans would be lower. And if the banks have a higher cost of funding, this would actually be a double whammy for them. So they would actually compress the margins for them both on the top line as well as the bottom line. And they will be discouraged to compete and therefore reduce their market share in this space. And we believe that in 2017, this would be a trend. So here's the chart for our breakdown for the market share. So in 2015, we can see that for the Singapore housing and bridging loans, the other competitors have actually steadily moved up in line with the growth of the system loans. But only in 2016 you see there's actually a reduction in expense of actually the three local banks moving up their market share. In the space of the building and construction loans, the loss of competitors' share in the market is more striking. But only UOB here, for UOB, we see that there actually have been the they have positioned themselves outstandingly to capture more market share than even the other two as compared to DBS and OCBC. So you can see here is a rise of $4 billion worth of Singapore building and construction loans as compared to $1 billion for OCBC and $2 billion for DBS. So given the momentum that we can see in 2016 for UOB, we believe that in 2017 they will be able to carry on with that and capture the public sector building and construction contracts. And finally, we have a peer comparison for DBS, OCBC, and UOB together with the finance companies. You can see that actually the three Singapore banks are still trading at a premium to book value. It has been a tradition, historically they have always been trading at a premium to book value, but we believe that this trend could be challenged. Therefore, our valuation of a discount of 5% to book value actually is trying to point out or trying to be in that spirit that the banks are facing headwinds in terms of their net interest income growth. So as previously our sector report, we have alluded that the net interest income is actually makes up more than 50% of the total income. That's one. Second, the building construction and the home loans business are a major portion for the three banks. They are both the building construction and the home loans themselves together combined would be close to 50% in total for each of the banks. The Singapore portion itself for home loans is, we estimate, is about 20-25%, and the building construction is also around that composition. So if what we are trying to say is that if the home loans and the building construction segment is going to look a bit more subdued, then we will not be able to find a lot we will not be able to expect a lot of growth coming out from these three banks. So the rating that we have here reduced is because we believe that the prices have moved up quite aggressively as compared to the potential, the fundamental potential. So so in that sense, if the prices were to maintain or to come down lower, we could reduce it to, we could actually improve our ratings to neutral. The reduced rating is not to mean that the banks are supposed to come down a lot lower, or there's some, or it is fundamentally a problem. There's some fundamental problems with it. We are not alluding to that, but rather is that the price actions of late has been a little bit more aggressive for its for the fundamental picture of the three banks. So as for the finance companies, we can see that it's still trading at a discount to book. So with the new regulations, what we would see is, what we'll try to observe is how the uncollateralized lending would flow into the collateralized space. And if that flow is significant and smooth, right, we believe that the finance companies could move up higher closer to book value. But unfortunately, we have not had any coverage on the finance companies, so we do not have any investment actions for that. And that comes to the end of my presentation for the banking and finance sector.
Thanks, Jeremy. This is Paul here. We initiated Asian Pay Television Trust on Friday with a buy call. Okay, we initiated Asian Pay TV with a buy rating, target price of 64. This implies a 43% upside. The stock is now giving us a 13% dividend yield. Basically, what Asian Pay TV Trust does is something somewhat similar to StarHub. They provide cable TV pay services and also broadband services. The market cap of this company it's about 704 million. That 504 that you see on the slide is actually a US dollar. The major shareholder for Asian Pay TV is Temasek Holdings. Okay, we'll start with what Asian Pay TV does. Basically, it's a Taiwan-based company, and it's important to note that this is a business trust. Okay, it provides cable TV and broadband service in 5 provinces. That shaded area that you see, the northwest of Taiwan. It is a business trust with 100% economic interest. It essentially owns 59% stake in 4 of these areas and 8% in one, but what they do get is 100% economic interest. So basically all the profits it belongs to the business trust. The third point, which is the 760,000 customers. This is very important because the key to this company is the stability, and the number of subscribers paid cable TV subscribers has been stable, and albeit growing at a very marginal rate. But most important is that there is no churn or no decline in the number of customers. In the Taiwan context, it's the third largest cable operator in Taiwan. That's not really important for us. Most important is where they operate, and because they are the sole or cable TV operator in that 5 locations. Another important trait of this company is that the revenue is some monthly subscription fees. This is very important, as this represents annuity-like recurrent revenue for the company. If you turn on to the next slide, in terms of the investment merits, obviously the high yield is one of the attraction of this trust, and also worth noting that this 13% per annum yield is actually paid every quarter, quarterly. So that gives you about obviously about 3% per quarter. We call it monopolistic because there is basically no other choice for cable TV. If you want to watch pay TV, you essentially have to use cable. The other alternative is internet TV, which is run by Chunghwa Telecom, which is essentially like your Singtel TV operator, but due to restrictions on their or inability to capture the local content, they have not gained much traction in the pay TV services. The third point, and as to the other reason why we like Asia Pay TV Trust, is the annuity-like revenue stream. As mentioned before, they get a monthly subscription fee of 20 plus Sing dollar every month, every year, and this has been steadily growing every year. And most important is also that watching TV is affordable and the most popular form of leisure activity. And the final point is the high infrastructure and content barrier to entry. As you know, it took them almost 10 years or so to build up this infrastructure. That little plug, that little cable plug that you see in every home is extremely hard to build into, and in order to build up such an infrastructure, it's very costly and it takes a long gestation period. And finally, the other barrier is the content barrier. Due to the large number of subscribers that they have, any content provider that is on a pay TV format will want to have the large 760,000 customers that they have. Because the content arrangements in Taiwan is a bit unique. The content provider actually takes some advertising revenue, and so for the content provider, a large customer base is very critical for them. As the larger the customer base, obviously, the better the advertising rates that they can get. As to the final slide, and as to the investment risk, the main risk for this Asian Pay TV Trust is essentially the regulations. Okay, because it has such a large, it has a monopolistic trade, so there's always this risk of regulations to cap them. Okay, the first risk is the price cap. Every year, Asian Pay TV has to approach the local government to have some guidance on the monthly subscription that they pay. It usually is unchanged, but in 2016, there was a decline in the subscription fee that they were able to charge. Part of the reason was the weak economic conditions in Taiwan, but also more importantly, obviously there was some government change in Taiwan in 2016. Okay, the second regulatory risk to monitor is the a la carte pricing. Right now, if to subscribe to the 105 channels, you have to pay for everything. But there's always been talks that the authorities might want to give the customer a chance to choose only the content that he views, and there's always the worry that obviously the customer will just pick the top 20 content and ignore the rest. But that may not be such a large concern for us, because Asia Pay TV has a way to somewhat bypass this. What they can do is to tier the contents in such a way that in order to to capture or to enjoy the most popular content, you have to pay for the whole bundle. So in effect, it could actually be just back to square one and nothing essentially changes. The third regulatory risk to monitor is, as mentioned earlier, the other threat for Asia Pay TV has been uh, internet TV, basically watching your internet, watching TV through the internet, which is by Chonghua Telecom. So right now, Chonghua's weakness is that the inability to capture local content. They've always had challenges in making arrangements with the local content, but there has always been talk for the last couple of years that the authorities may actually compel the local content providers to have their content on the IPTV. On the second bullet point, is worth noting that due to ownership restrictions in Taiwan, there's a 60% ownership restriction whereby any cable TV operator, any majority holder can only own 60%. So essentially, APTV does not have a 100% stake, but it will enjoy 100% of the economic interest. Okay, the third bullet point in terms of new entrant, just a bit of history. In 2012, the authorities actually opened up the, uh, the franchise areas, or the areas which APTV operate, and all the other cable TV operators. In the past, they split it into 52 areas, well, 51 areas, sorry, but post 2012, all this has been consolidated into 28. So there were concerns that there would be new entrants or new competitors. There were rumored to be two competitors vying to compete with APTV in one of the largest areas, which is Taichung. And Taichung takes up almost 40% of the revenues. But it has been almost 2 to 3 years, and nothing has actually materialized, despite the hype that these two operators might want to build up the infrastructure and compete with APTV. But so far, nothing has happened. And the final point on the kind of unique risks faced by APTV is that, like all trust structures, including REITs, they do rely on some leverage to pay dividends. And similarly, there's always a refinancing risk. But for APTV, any refinancing risk, if any at all, will be in 2019, because they've refinanced most of their loans to mature in 2019. That's it for me. Thank you.
Okay, we have a question about whether research report for Asian Pay TV is available for download at Poynt's portal. Okay, you, it is available for download, and we also going to look at how you could download it from the stock analytics when you open up that window. So we will actually make changes to that, or we actually make sure that it is up there also for you all to download. Thanks. Um,
Yeah, hi. Thank you. We have a question. Thank you for the question. We have a question regarding will the local government refuse to renew the license of APTV? If you look at the report at the appendix, we do highlight some of the. They have two licenses. One is the broadband and one is the cable. They renew every 7 to 9 years. There's very little unlikely for the government to not to refuse any refusal unless they have done some major uh, uh, contravene something major, which is very unlikely. And more importantly is for us is that they have the infrastructure. That infrastructure, all the cable infrastructure all belongs to APTV. So that's also very critical. But in terms of renewal, that's highly unlikely because anyway most of the content is provided by a third party. They are just an infrastructure provider, and if there's any issues with the content, at most the issue will be brought towards the content provider. I hope that helps. Thank you.
Okay, there's a few questions for Keppel DC REIT. Let me go to the slide. Okay, so the first question on Keppel DC REIT is why is the forecasted DPU of 6.6 cents lower than the consensus forecast of about 7.2 cents? For sure, there's no way that I can give an explanation on how the consensus is getting 7.2 cents. But what I can point out is that if you look right here, DPU first quarter 2017, the recurring DPU is 1.74 cents, um, and here this the recurring DPU is 1.74 cents. 1.74 cents. If you multiply it out, this 1.74 cents actually meets about 26% of our full year forecast, and the 1.89 meets 28% of the full year forecast. As for what is the discount rate, the discount rate is written on the first page, bottom right corner of the report. You can refer to it. There is 6.99%.
Hi, thank you for the question. We have another question on APTV. Basically, it's regarding the sale of Macquarie. Macquarie is the trustee manager of APTV, and it recently has been sold to a Taiwanese individual, which is linked to the Hong Hai Foxconn Group. At this stage, we can only guess or even speculate what are the possible permutations or scenarios. Um, APTV is a very strategic asset for any operator. And firstly, that individual that acquired the Macquarie's stake, he has a mobile offering, a mobile operator. He owns a mobile operator in Taiwan. So, as noted in the report, one scenario or permutation is that APTV could work with them to offer some quad play, which is basically a telco operator that offers four types of services: broadband, cable, mobile, and so forth. Uh, another possible scenario is that, as mentioned before, Honhai is very interested to move into the digital space, as you can see from the recent acquisition of Sharp and so forth. So one permutation or one scenario is that they're also looking into launching more connected products into the home, like Internet of Things and smart homes. So Asia Pay TV, and this is purely our own guess or speculation, has the customer contact and has the customer base. So any new products that they want to roll out, especially Internet of Things and connected household devices, APTV will be very critical because they have the customer base, and we want to roll out such a core product. APTV could be also helpful to Honhai. But just a final point, worth noting that ownership of cable TV is a very contentious issue in Taiwan. Any Taiwanese that tries to own it or corporation is under immense scrutiny. So that is why they can never take an outright ownership of APTV, and it will be more of working together on maybe a joint venture level and so forth. Yeah. Thank you. Hope that helps. Thank you.
Thank you very much for attending this morning's webinar. Do tune in next week for our next session. Thank you very much.